Welcome to This Week in Intelligent Investing, where we examine timely and timeless investing topics to help you become a better investor. Enjoy authentic, unscripted discussion featuring Phil Ordway, Elliot Turner, and other thought-leading investors, brought to you by MOI Global. And now, here's your host, John Mihaljevic.
Welcome, everybody, to a new episode of This Week in Intelligent Investing. Great to have you all with us. Joining me are Elliot Turner and Phil Ordway, as always. Looking forward to a great conversation. Today, we're starting with Elliot. Over to you.
Great. Thanks, John. Hello, everyone. So today I wanted to talk about an idea that I find to be both fun, interesting, and important. And that idea specifically is looking for emerging quality in investments in contrast to established quality. And if there's one identifiable problem I have with established quality, it's the fact that quality tends to be very clear when people see it, and quality that's clear is recognized. In other words, it's priced into the market. So when a quality stock is labeled a quality stock, right then your expectation of above average returns by default goes to average returns, I would say. There are some ways in which you could find, I think some outsized returns in quality, and quality stocks to demonstrate, considerable volatility within a year and from year to year. So there are opportunities, like tactically, I think, to get above average returns out of quality. But by and large, over very long times, the idea is quality delivers, quality is recognized and delivers accordingly. So first, to talk about emerging quality, I think it's helpful to talk about the traits that are exhibited by what you'd call quality companies. So a few things that come to mind would be persistently high returns on invested capital that are not just persistent, but consistent from one year to the next, right? So it has to be above cost of capital, and it shouldn't be volatile. It shouldn't oscillate from one year to the next. The next thing a lot of people talk about are typically very high margins, but in this bucket, I'd add the often overlooked very high capital turnover, right? It could be either or some like combination of the both. And here you're looking both in an absolute and a relative sense. But don't forget that overlooked high capital turnover. I've seen some people define quality purely in high margin terms, and I think you'd miss some interesting companies that I would definitely call quality in that sense. Then, often you think about a somewhat fixed cost structure where incremental growth leads to some degree of incremental margin that's above core margin. So I think that's often one thing I associate with quality. Relatedly, growth requires little incremental capital. Typically, you'd want to have a strong management team with aligned interests, though in some ways the beauty of quality is that it should deliver with or without a strong management team. That said, definitely want to check the management box. Then on capital structure, you'd want an appropriate capital structure. I use the word appropriate here because I think there's, different companies require different things. But typically, I'd say maybe even appropriate skewing in the direction of conservatism, because that gives some flexibility in how the company is managed and some resiliency if there's turbulence from some other forces. Then you'd want little to no competition, or at the very least, very rational competition. You don't want to have players who are, driving price lower or spending profligately to steal customers. And then last, you probably want to have growth that's at or above GDP. And typically this is coming from a persistence of the existing customer base and some modest customer growth. Now, all of these things, are recognizable. You could identify it. Most of these things are, distinctly quantitative in nature. There are certain qualitative elements that, you'd want to use to triangulate each of them. But this is what quality is. But emerging quality, I think, is an opportunity to get, outsized returns. When a company goes from what's considered to be a fairly good company to a quality company, there's going to be a repricing in the market that is, it might happen over the course of years or it might happen rather swiftly, but either way, it's going to be something that's above average, above expected, and above normal. So, some of the traits that I think of here, you definitely want to have like return on incremental invested capital that's greater than ROIC. So going forward, the trajectory is that ROICs are rising. So not just persistent and consistent. You want them to be, they could actually be low at this point, but you want them to be rising, going up, going forward from here. You want to have high operating leverage. I think you ideally have secular growth forces where each incremental unit of growth is driving higher margins here on out to a faster degree than is evident in what I said above about quality. Then, in terms of like these growth forces, you want both the addressable market itself to be growing swiftly, decently faster than GDP, and the company itself to be growing faster than the addressable market. So in other words, the company should be a share gainer to have these signs of emerging quality. And you also want multiple levers to grow. So obviously just, capturing TAM alone isn't enough. You want to have a deepening customer relationship, which means more engagement from your existing customers. So here it could mean like, something like Roku where people are watching more hours a day, or it could be, something like Amazon where people are just giving more wallet share each year to what they purchase on Amazon. Now, Amazon is pretty established quality these days, so I'm just using that as an example to illustrate. And you also want to grow the absolute number of customers too. So you have not fully captured the mature number of people that'll be using the product or service or whatever it may be. Here's what I think is a really important one: consumer surplus and an underpriced product. I think this is incredibly important, perhaps the most important one. You want customers to be feeling like they're winning by engaging with you, the company. And I think this is important because it translates both to long-term pricing power, which is something that you could use either to drive top line by raising prices, or you could keep competition at bay, or most importantly, you could build towards Nick Sleep's scale economies shared, right? Where, by virtue of longer term, using some of your operating leverage and using some of your scale to keep prices low for consumers, or even drive them lower to keep them happier and feel like they're winning every day, even more than they were the past day. Insofar as competition is concerned, you want it to be either low or rationalizing. But in today's world, you're often going to face like large platforms attacking the market as well in one way, shape, or form. And I think here there are factors to address on a case-by-case basis. But like the company itself should have a singular focus around a core essence, and there should be an alignment of interest with whoever the company is servicing. And that's a crucial distinction, area I made a mistake in the past as well. Like you want to make sure that whoever the company's servicing, and oftentimes in today's world, part of why I'm using these terms is like the customer is not the same as the supplier, right? A lot of emerging quality companies might be marketplaces or might be bringing, two kinds of people together as part of the service. You want to have a very clearly defined and articulated problem you're solving for your customer, and you want to know who your customer actually is. So if you are one of these platforms that's uniting like supply and demand, you want to know whether it's the supply side or the demand side that's your most important customer, and you want to build accordingly. And then the last thing I think about is you want a product itself that's not finished and has the opportunity to improve in multiple directions. It should have if you go back to one of our conversations that I was talking about from the book Where Good Ideas Come From, exploring the adjacent possible, you want to have a lot of adjacent possibilities, and they should be both horizontal and vertical possibilities. And this is about the product itself, improving the product, spreading its tentacles, and it's about the mandate that the company has to engage with its customers. And, when this is informed by the acquisition of data, like every day the company acquires more data from doing business, and if they could directly deploy that data to improve the product, that's like even more powerful. So these are some of the things I think about in emerging quality. Curious what you guys think about quality, the opportunity to capture outsized returns in quality itself versus emerging quality, and how you think about emerging quality.
Yeah, it's interesting. I never thought about it as a change, as emerging versus static. I think you're right. It's not only having a moment, but I think because once a company is established as having the characteristic defined as quality, it's pretty often priced in. So yeah, I think the definition that's always made the most sense to me is just a company that throws up one easy decision after another, as contrasted with a company that just has one agonizing decision after another. And so, again, it gets into an element of predictability. I mean, predictable's the wrong word for me, just because the world's unpredictable and no business exists in a vacuum. So no business is predictable because the world is not predictable. But it's just when something bad happens or when something good happens, the business in question, if it's high quality, has a obvious and attractive, or at the very worst, an acceptable solution. So that's kind of how I've always thought about it. I mean, some characteristics that I've always looked for are more on the qualitative than the quantitative. I mean, I think it goes without saying that there has to be a high and sustainable return on capital that certainly exceeds its own opportunity cost of capital. And it has to continue over time. I mean, to your point about the volatility, I agree. I mean, you don't want it bouncing around like crazy, but it doesn't bother me too much if it goes up and down for some reason that can be understandable. But again, it's sort of like the Potter Stewart, Justice Stewart. You'd recognize it when you see it, right? So some things that I look for that I don't think get quite enough attention sometimes are a really deep bench of people, right? I mean, I think it's pretty obvious when a company, high quality or otherwise, has a really great charismatic CEO or leader, or even a really great, C-level executive team. But when you peel back that next layer and you find some relatively anonymous 20 or 30 something working way down in the organization that nobody would have ever had any reason to talk to, and that person just blows you away, that's a really good sign. When you find out that the bench of people is 2 and 3 deep, so that if somebody were to leave or get hit by the proverbial bus, the next man up would be really good. That's a great sign. When an organization is pretty quick and not ruthless or heartless, but is removing bad people or bad fits and always kind of refocusing. I mean, that was the one thing I liked about the Netflix book, is just having that, focus on culture and the high bar. And if somebody doesn't work, you give them a very generous exit and move on quickly. I think that's a great sign. Other things are, misclassification. So company gets lumped in with an industry where it doesn't really belong, and then it starts to dawn on people that can be an emerging quality characteristic, I guess, where the business was already or always quality and is just sort of the world's catching up to it. The industry around it's changing. I mean, I've often seen where an industry is consolidating, or an industry that was once hyper competitive or oversupplied, overcapitalized, and just really not competitive or overly competitive from an economic standpoint. And that's changing. That can lead to some quality characteristics emerging. I think maybe the most common one is just one bad segment or one bad business within a broader business masking the gem underneath it. So that was the source of my single biggest investment, and the single best investment I've made certainly in the last 5 or 6 years was an exact situation like that. So those are the things I would highlight. And it's a good point, because nothing is static, and something that's, again, you have to look at it almost in reverse too. If something's quality now, what are you looking for to see that it might be going backwards, right? A disemerging quality, right? Something going the other direction. You have to constantly be aware of it.
Yeah, I'll share some thoughts. I think it's a great kind of thing to look for, because that can result in some of the best investments. I think, the kind of the first derivative of the returns on incremental capital, so the change in that is a quantitative thing one can look at. I think, Elliot, you talked about that, or kind of EVA, the EVA framework. If a company starts kind of looking better and better on that. Phil, as you say, multiple segments where kind of either there's an actual action to get rid of the not quality segment, or over time the quality segment simply becomes more and more dominant because it has better growth characteristics usually. Or you have a quality business that is married to a non-quality business, where basically you shouldn't value that at less than just a quality business without that kind of capital intensive business. I'll give you an example. I mean, if you have, let's say, two hotel operators and they're valued the exact same enterprise value, have the exact same asset portfolio. Let's say everything is the same except one hotel operator owns all of its hotels, owns the real estate, and the other doesn't. Well, the one that doesn't own all the real estate is going to look better on quality metrics. But actually, the one that owns the real estate is the better company because it matches all the quality characteristics. You just have all this excess capital basically tied up that you can get rid of. So sometimes people overlook a good business because it has more than just the good business. I think, sometimes you see a change in company culture as a new management comes in and really wants to shake things up in a positive way. That can sometimes lead to a change in business quality, or simply a change in business model or focus of a business. I think Naked Wines is a great example on that. Another thing that maybe might be worth looking at for some companies is the Net Promoter Score. Sometimes that can be a leading indicator of the quality of the business over time. I think a case study as well, Phil, that I'm sure you are familiar with, is the airlines and how they basically went from no quality to having quality before COVID hit, of course, but they were on a good path. And I think, Elliot, as you said, part of quality is also the length of the runway and kind of how much growth there can be and what the greenfield opportunities are for a business. And that's why some small caps turn out into huge winners, and why often maybe the small cap land is the best place to look for that kind of emergent quality. M&A, I think, is usually overhyped, but sometimes it really can change the quality of the business if it's really a truly kind of outstanding transaction that just changes the model. And I'll close with our favorite example of Twitter, where I feel like you really need to have the foundational ingredients of quality in place. And a company like Twitter has that. It's not going to show up on quality screens to date, but it has those foundational ingredients in adding a ton of value to its users that's under-monetized at the moment, at being addictive, at having people love it, having people feel like it's a really huge value add in their lives. And these are people who are not just kind of lower tier of society. These are people who have a lot of spending power. So when you have those kinds of foundational ingredients in place, I think that's a really great setup. If you then also start seeing that the company is actually moving in that direction of executing on quality and focusing on quality in the business sense, not just the product sense.
Yeah, I think those are some great examples from both you guys. Really good frameworks. I was trying to focus a little more in isolation on the company itself, but both of you touched on themes of like overt change in the business itself, whether it be compositional change of what they're doing, an emerging sector of quality, new management, M&A. All those things I think are really important and really interesting angles to explore for where there might be emerging quality. Like, I view change as one of the most important parts of my process, asking what's changing in the sector, what's changing in the company. And, to that extent, my greatest successes in investing have been in instances where change is a key pillar of the thesis and moving in the right direction. To riff off of Twitter, I think change is an important part of that too, because there's an inflection from being, I'd call it undermanaged, having a completely new foundation underneath it beyond, you spoke, John, to the customer foundation, which I think is incredibly strong, but the technological foundation took years to change beneath the surface. And now here we are. And, things get to start looking up as you get to capitalize on that. I love that you mentioned NPS, John, because that's one of the things I use quite often. That's a strong sign of quality because it both tells you that customer acquisition costs are going to be lower for that business than others, tells you that churn, whether or not it's a subscription offering, tells you churn's going to be lower. Their customers are going to stick with them, and it's going to be a good loyalty situation. So all that plays into every other factor of quality. One thing that I found funny is, John, again, you called out hotels, the vertically integrated one owning their property being the better business. Meanwhile, here we are, just I'd say, 3 years past, maybe 5 years past, when the major hotel companies actually split off their real estate deliberately and purposely to kind of shine a light on the quality of the management side of things, and created two separate operating businesses out of it. I don't know. I don't know what to think. I remember hearing the pitch so strongly that these are now quality companies because they're unencumbered by their real estate. Not sure I know the answer to that, but I find that funny because to the extent that quality is in the eye of the beholder, right? I think different people could focus and isolate on different things, but I too often find the vertical business in that sense to be more quality than the standalone. Again, not sure what I think in the hotels, but those are all interesting examples you guys gave.
Yeah, I'll 2 points that jumped out at me. One, just on the net promoter score thing, I'll try to find it and send it around in the show notes. I think what it's trying to measure is obviously great. When you dig into actually how it works mechanically and what it was originally intended to do, I think it was a Bain consulting project, and the guy who originally kind of promoted it and came up with it has now said it's been taken way too far. So I would issue a little bit of a caveat on NPS. I think sometimes it's a little bit misapplied. So I think what it's trying to do and the work that you should seek to replicate is super valuable. But when I read like, oh, this company's great just because of the NPS score, I don't really find it all that meaningful, frankly. I mean, I guess it could be meaningful if company A has an NPS that's way higher than company B and they're direct competitors. That'll often signal, something meaningful going on underneath the hood. But other than that, I'm not sure that I've found NPS to really hold up to the kind of rigorous analysis that you're otherwise doing and wanting to capture here. So, so a good example of that actually is the airlines. I'll take the bait, John. So I was thinking of this all along, of course, and I think it met a lot of criteria. So again, for anyone who hasn't heard this before, my usual preamble here: none of this is investment advice. I'm very intentional about not talking too much about things that I currently own for a whole host of reasons that I won't repeat here. So the airlines now I can talk about quite freely because I sold them over a year ago, right as COVID was coming across the bow and in early March of 2020. So I can look back on it with no dog in the race and hopefully clearer hindsight. So I think where it clearly failed and where I'm open to criticism or acknowledging that it didn't work out, or obviously didn't work out as I'd hoped, but where it clearly doesn't measure up is that it's not the kind of business that throws up one good, easy decision after another. It often throws up hard decision after hard decision. So on that measure, it wasn't quality. It never it was never going to be quality, and it's still not today. I would say it's actually in far worse shape today than it's been at any point in the last 10 plus years. On that measure, I would say pretty much every decision the airlines have faced for the last 12, 13 months has been, worse or really, really, really bad, right? I mean, it's just one bad decision after another. So where I think it was really interesting a few years ago was I think it was very misclassified. They were basically above average industrial companies, whether you looked at them at the S&P 500 aggregate level or towards their transportation industrial peers. They were average to above average in every possible way and still considered kind of bad businesses as they'd been forever. And what people had really missed were two things. One, that there was now this huge financial consumer marketing business and the loyalty programs that was layered on and that was being mischaracterized. And second was that the industry had changed and that the consolidation had eliminated a lot of the excess capacity and the bad supply in the industry and taken out a lot of the actors that just didn't need to be there. So you had a bad business, kind of a perceived bad business being overshadowing a really good one. You had a misclassification of what the business really does. You had an industry that had changed for the better in a major way. And then, the people that I met at every level of the company, I think you'd be shocked, or most people would be shocked, at just how good airline management has become and how rigorous and data-driven and rational it really is. And I think if you compared it to a lot of companies that are supposedly very high tech or software oriented, or they're just happen to be growing, frankly, I think you'd be stunned at how much smarter and more rigorous the work that's done at the airlines really is. But again, I think the lesson, if there is one on the downside, is just that because of some of the fixed cost nature, fixed versus variable costs in the business, that you're never going to completely eliminate the substitutability of the core product and just a whole host of factors that make it just a somewhat difficult business. So,
yeah, well, I'll highlight John Rainey, the CFO of PayPal, is like an awesome person. Who came from the airline world, from United, and I was extremely impressed.
That's true.
So you're contrasting, like the tech and the airlines. Here you go, is someone from airlines making a meaningful contribution at a technology company in very interesting ways. And I think he's had pretty smart approaches. If you look like beneath the surface, some of the things he's done to kind of like tweak around pricing levers they have on funding instruments and on actual payment options, he's been pretty brilliant. I think you also made I'd call what you said about NPS a caveat, and I think you're 100% right. It has to be used in a relative sense. Like you can't say the NPS of company A versus company B in completely different sectors has any relevance. But if you are by far the highest NPS in your given vertical, in your closest competitive set, that's a distinct advantage. It's effectively saying your customer acquisition cost is much lower. So you have more that you could spend on, whether it be R&D or really just driving lower price for your customers. That's
wouldn't you say though you could just go try to measure the customer acquisition cost? I think that's probably my second biggest criticism of it, is it's just trying to, when they don't capture enough detractors, or when the detractors aren't really in the sample size, it just becomes kind of a meaningless number. So I think it's trying to put
depends, right?
Sure, exactly. That's the whole point.
Like your CAC could be exactly equal from one company to the next, but one is confident they have a 10-year LTV and the other is not so sure they have a 5-year, right?
For sure. So I think that gets to the point, right? Is that whatever the number is only as good as the inputs and assumptions behind it. And I think in more cases than people are really aware, the inputs and the assumptions in NPS aren't really all that valid. But again, if you can find an apples to apples comparison between two like companies and one has an NPS that's just way, way higher than the other, then that's a good place to start looking to see if that's really valid, because chances are it is.
And by the way, one thing I'd add is you don't need NPS itself as a trademarked metric or whatever. What you could do is surveying work on your own, independently, asking the kind of questions that would inform someone in a decision-making position what
exactly.
The true customer sentiment is like, and the relative customer sentiment is like. And I think that's one of the most powerful resources we have at our disposal. It's no wonder And I think Tiger Global was like a seed or like a Series A investor in SurveyMonkey and has held the shares ever since. That company makes a lot of sense for someone in that position to be both a really large customer and an owner, capturing some of the economics.
Yep.
And then, one thing I loved that you said, Phil, is these companies with one good, easy decision after another. I mean, I've fallen into the trap of some companies that have hard decisions. And, I think it gets to this idea that there's no company that you're just viewing over a time period. There's like many short time periods that add up to a long-term time period. And there are many decisions that you face at different junctures. So there are some companies who, when COVID hit, should have been like stepping on the pedal and leaning into opportunity. And there are other companies that should have been retrenching. And every company faces different decisions. But the first decision you make at some key junctures, there's a path dependency that follows from them. And if you make one wrong decision, it tends to lead to a worse decision tree and further bad decisions. So, the more easy decisions you have, like the less likely you end up on a decision tree path that could lead you down sliding doors where you're like, I wish I had done that instead. So yeah, I agree. I think that's a really interesting, important one. Though that's not to say there's some companies who face hard decisions that I wouldn't put in the quality bucket. I think that just makes it a little easier to get it right.
Yeah, I think, and that's a good point. I mean, look, I think there are companies with elements of quality, but don't check all the boxes. I mean, I don't know of any company that checks every box you'd want in this area. And again, there are companies where, like the airlines or whatever, where I could see saying, okay, yeah, this business doesn't throw up one easy decision after another. It actually faces a lot of hard decisions. But there's such a disparity between the perceived quality and what I think the real quality is, or the perceived value and the real value, right? Because that's really ultimately what we want as investors. So I am not averse to going and hunting around in businesses that the rest of the market or most analysts would say are not quality. Because if you can still find again, it doesn't have to be like an old school, like net kind of hunting through garbage and cigar butts kind of strategy. But if you can find businesses where the gap is enormous between real and perceived quality or real and perceived value, and it's in your favor, so long as it continues to be in your favor and you're not wrong. I mean, that's what we're all looking for, right? And so, in my opinion, a lot of times it's easier to find companies where that gap is big and in your favorable when you're not hunting amongst all of the trendy, most popular, high growing unicorn compounder bro type companies, right?
And it relates directly to our conversation of, in essence, if you want to find these like really great returners over a long period of time, you want companies who have much lower multiples, right? Our conversation last week, you're not going to get the truly great like 20-year companies by starting with really high price to sales. You're going to need some sort of price to sales uplift. And so to that extent, you're going to be looking at companies that have some fleas. And so maybe parts of emerging quality are just the ways you could pick away one flea after another and effectively de-risk more so than just make things better in an absolute sense.
Yeah, and I think, every business I feel like has some KPIs or metrics that apply uniquely or almost uniquely to that business that kind of could help you recognize emergent quality before it's obvious in kind of the headline numbers. And Elliot, I think you talked about this, but let's say a subscription-based business. I mean, if the renewal rate would be super important, and there's a huge difference between an 80% renewal rate and a 95% renewal rate. The one with the 80% renewal rate could actually make up for that through like really good marketing or customer acquisition or whatnot. And so the headline numbers may look fine, but actually, an 80% renewal rate means a 5-year customer life, and 95%, that's a 20-year. So that's a huge difference. And I feel like you want to kind of find those key metrics within each company and track those really closely to see is anything meaningful changing there.
Yeah, I'd
And I
give a
think
good. Go ahead, Phil.
that's right. Sorry. Yeah, I was just going to say, I think that's exactly right. It gets back to my point earlier about NPS, is where I wouldn't want to take NPS's word for it. I'd do exactly what you just said, John, which is you go out and you talk to the customers and you survey the customers. And for a subscription business, let's say, of course, you'd want to look at what the historical churn has been like, but then you'd go out and kind of marry it up with some survey data too and say, okay, if there's a recession or there's a problem or whatever, how likely are you to drop this subscription and this service from your life? And if everybody says, oh, I can't live without it, and the data marry that up, then say, yeah, they've certainly stuck with this through thick and thin and it's growing, whatever. That gives you some pretty good confidence that that's going to continue to be the case for the company, and it's going to throw up one easy decision after another, and that there's going to be a lot of market share for them to take, and they're going to grow over time. And that's exactly what you want. And I don't frankly know anybody that doesn't look at it that way, but it's probably a small segment of the market that actually goes out and does that work, right? Sorry, Elliot. Go ahead.
Totally agree. I just wanted to offer an example, I think, that helps illustrate this in a way to kind of think about it, because I often find that helpful. PayPal, when they went about their consumer choice strategy and struck partnerships with Visa and MasterCard, specifically what they were looking to do was make customers happier with the product. And as an outcome, growth in the customer base, active users, accelerated. And a lot of people would ask them questions like, so why is active user growth accelerating? They were acquiring the same number of customers, but churn was going way down, right? So to your point, John, about the 80 versus 95% retention, like churn was going way down, and in the process of churn going down, user growth goes way up, right? There are two ways to attack the same problem. And I think that's interesting and important. And, they had told people at the time in 2016 when they announced these partnerships, hey, we A/B tested this in the UK market and we know our churn's going to go down, but people didn't believe them. So there's often a lag with which some companies put things forward that they think and they know could drive some of these forces, and people don't pick up on them. So that's just another way to find opportunity in the market about it. It took like a full 2 years for the company to prove that what they had theorized was actually indeed true.
Great. Well, let's move on to our second topic. Phil, I'll turn it to you.
Thanks, John. And Elliot teed this up perfectly for me, so I don't even need to introduce it very well, because as he said, if you're going to have a really good long-term result, you need to have all the things that he lined up there. And then what he mentioned right there at the end, which is kind of a starting point that's reasonable from a valuation perspective. So I unfortunately can't remember where I saw this. I apologize for not giving the proper credit where it's due. Somebody on Twitter posted a screenshot of it, which just reminded me of it. So you can all do it yourselves on anything you like. But somebody pulled down the top 50 performing publicly traded stocks that were continuously in existence from April 2006 through April of this year, so the last 15 years. So to set a baseline for that, it's worth doing. What do you guys think off the top of your head? What do you think the S&P and the NASDAQ or the Russell 2000, any or all of the above, what do you guys think they did per year over that 15-year period? You got to guess.
So you mean the CAGR and the S&P, NASDAQ, and Russell over the last 15 years?
Yeah, exactly. The total return you got by owning those over the last 15 years. So this would have been through last week.
So from 2006 through last week. So you're starting pre-crisis.
Exactly. The interesting thing is you're starting pre-financial crisis, going down through the financial crisis, roaring out of it, going into the COVID pandemic, and now coming out of it.
I'm going to go 12% S&P. So 12% CAGR in the S&P. And we're talking total return. So I'm thinking with dividends here. Right. I'll go 16% NASDAQ. And let's see, my brain wants to say that the Russell lagged all. So 10% total return Russell.
Yeah. John, you way off, or what do you think?
I don't know that I have a real good take on this. If I can.
All right. Well, you're not going to do a whole lot better. Elliot was very, very close. I mean, the S&P was actually just over 10. And these Bloomberg data include dividends, I'm almost positive. So the NASDAQ was 16, which is just just a stunning performance, right? You almost nailed that. And you're correct. The Russell lagged both of them by quite a bit at just over 9. But that gives you kind of the base rate for what the public markets did at a broad level. And it's hard to find a better 15-year period in all of history than that period. But it's amazing that out of roughly 3,000 public companies that have existed in the U.S., listed and headquartered in the U.S. On the major exchanges over that 15-year period, if you take just the top 50 of them, so that's the top 50 out of 3,000, the cutoff to make that is just under 20%, which really isn't, I mean, it's a big difference. Don't get me wrong. I mean, 4 points over 15 years is a ton. But that's a big difference between the index, the NASDAQ, and these individual companies. So it's pretty amazing. So the 50th best company returned about 19.7% a year for those 15 years. And the number one company returned an unbelievable 38.7% a year over that period of time. It went from a starting market cap of $1.5 billion to an ending market cap of almost $250 billion over that period. Now, sales went from under $1 billion to $30 billion. So sales also grew at 25% a year, but with sales growing at 25% a year, which is unbelievably awesome in and of itself, get to an almost 40% a year total shareholder return. The company didn't pay any dividends, by the way. You had to have some pretty good multiple expansion. And sure enough, the price to sales multiple went from a pretty reasonable 1.6 to a much more robust 8.1. I'm sure you guys can guess which company this is, right? It was Netflix. I think everybody knows that they've probably been the biggest winner over most periods of time. But the interesting thing that I found here was a couple of things. If you look at all of these companies that ended up as the big winners in 2021, look back 15 years ago from the starting point in 2006, there were 26. More than half of them had a starting market cap under $1 billion. Right. And almost by definition, the math would make it pretty hard. Not a single one of them is under $1 billion market cap today. But way back then in 2006, only 4 of them had a starting market cap over 10 billion. And now only 11 of them have a market cap under 10 billion. Right. So again, the math just kind of takes over. You go from small to very large in a big hurry over 15 years when you're compounding at that kind of rate. And there are now, of course, 2 of them that are over $1 trillion. So Amazon actually checks in at number 3, starting market cap of 16 billion, ends up at 1.6 trillion. Sales over that time period went from a smooth 10.7 billion to 475 billion. So that's an interesting one because the sales growth rate of almost 30 almost matches the investment IRR of 34. So the price to sales multiple there only went from 1.5 to 3.5, so it didn't go up quite as much. But interestingly, out of the 50, there were only 2 where the price to sales multiple declined. And again, you know how I feel about this. In terms of valuation, doesn't tell you anything. Multiples are a shortcut and a proxy. It's a pricing exercise, not a valuation exercise. We're not actually estimating future cash flows and discounting them back, et cetera, et cetera. But price to sales multiples are interesting because it ignores margins, it ignores capital structure, it ignores all that stuff, and it just gives you a pure look at what investors are valuing a dollar of sales at. And so Regeneron Pharmaceuticals, a really interesting company at number 12, compounded at almost 26% a year over that 15-year period, while the price to sales multiple went from 13 to 4. So it totally collapsed, and the stock was just a generational home run because sales went up 42% a year. So it went from sales that barely existed, 63 million 15 years ago, to 12 billion today. So that's one way to do it. The only other one where the price to sales multiple actually declined, and it barely declined. It started at just over 8 and ended at just under 8. So just a tiny dip of Salesforce. Another generational home run. Sales went from 4 billion to 204 billion. And so that's a 30% compound annual growth rate, which actually exceeds the total return of the stock at 23% and change. But every single other company had multiple expansion. And to your point, Elliot, just a minute ago, there were actually, at the beginning of this race in 2006, only 6 companies with a price to sales ratio over 5, and only 2 over 10. And now, if you look where they are today, the 6 that started at 5 or higher, there's now 36. So 2/3 of the company in the sample are trading at over 5 times sales. And there are 16 of them that are now at over 10 times sales. And so obviously, just the simple math of it would make it very, very difficult for those valuations and just outright size companies being that large to continue to return those kinds of numbers going forward. So I'll leave it to you guys if you want to chime in and opine and guess as to what some of the other companies are. I can throw out some of my favorites. But the other thing that struck me as really interesting was I went through and just very crudely assigned each one of them to one of 4 industries. So this gets back to something we were talking about quality a minute ago. I think assigning industries is really dumb and really unhelpful and leads to some really weird results where companies are saying company X is a tech or a software company when it's really not, or it just gets very arbitrary, right? I mean, what is Amazon? I mean, of course, it started as an online retailer, but is it just purely a tech company or a software company? I mean, of course not. I mean, it's a massive physical logistics operation at the core of it. So it's technology enabled, but this is where it just gets so arbitrary and ridiculous. I mean, Align Technologies, Invisalign, as the number 4 returning stock. Is that a healthcare company? Is it a consumer-ish kind of company? It's kind of both. So anyway, when I characterized all 50 of these companies, it was almost a dead even split between companies that were tech or software, at least as their primary designation. There were 13 of those. There were 10 that would be considered healthcare in some way, shape, or form. There were 12 that would be considered consumer, and a whopping 15 that would be considered industrial. And that was actually the most by number was industrial at 15. And I think if I'd have asked myself at the beginning of this, I would have said probably 25 of them would have been tech or software, and another 10 or 12 would have been like micro cap biopharmaceutical companies that just did home runs, and that really wasn't true. So that really kind of surprised me. So anyways, I'll stop there and open up to you guys for any observations or questions, or I can throw out a few more of them.
Who was the last of the 50 to get in there?
Interestingly enough, the last was Nike at a 19.7% compound return, a starting market cap of $16 billion going up to $175. And they had one of the lowest sales growth rates at 8%, but there were companies that were lower. Again, it looks like the lowest compounded sales growth rate was 5%. There were a couple, Mettler Toledo, which is an industrial company, only grew at 5%. Aon, another industrial company, AAON, was 5%. There were a few at 6 or 7. But yeah, Nike's price to sales multiple went from 1 times to 3.6 times, which helped.
Did AutoZone make it?
It did not. No, must have just missed it.
Got it. Yeah, because that one's really interesting as a case study in general,
for sure.
Right?
It is. No, it definitely is. I totally agree. Yeah, I don't know. I'd have to go. Here, I can put it in actually while we're talking.
Yeah, because I'll tell you what I find interesting. I mean, their sales growth was especially low, but they just strung out working capital to retire shares. And perhaps, was this market cap oriented, or was it total shareholder return that you screened for in Bloomberg?
No, it was, it's just shareholder return. So again, some of the market caps starting out were as low as definitely 100 million.
So it was TSR though. So companies who retired a lot of stock theoretically were credited here, and they still, like AutoZone.
Sure, if the price went up, yeah, for sure, yeah.
Yeah, were there any what you'd call like the serial cannibals of their own shares in there?
Yeah, it's interesting. So the starting date and ending date must have been just off, because Bloomberg has AutoZone as of yesterday at like 20.2% compounded over that 15-year period. So they must have been right there somewhere, which gets to how arbitrary it is to cut this off at 50, right? Because there are a bunch that are basically tied right there at the bottom, right? There's nobody within 300 basis points of Netflix, but you're within, literally 1 or 2 basis points of several down at the bottom of this chart. But
that's an interesting question. What was the CAGR of number 25 on the list?
25 was Edwards Life Sciences Corp, and that was 23.2%. a year. So you start bunching up pretty quickly once you get below the top 10, really.
Yeah, that's really interesting. So, I mean, in general, it's just really hard to find 20% CAGRs over 15 years. And you hear people on
Exactly.
Twitter talking about how like every company in their portfolio
That's what I
is
mean.
going to CAGR at 20%.
And it's one thing to do it for 5 years. It's one thing to do it for 15 years. You know, that period sort of encapsulates the average life period of a public company, right? Either through failure or acquisition. And so to do it for 15 years is just stunning.
And the market has a really hard time pricing high growth, especially high growth that's like accelerating. But you know, the persistence of growth over a long period of times. I mean, I still keep the Mobson base rate book open. I used to keep like as a benchmark, you know, no company could grow a decade for 20% really, though I think in some ways that might get ripped up in the, call it the 2000s playbook, because there will be some companies that deliver on that, surprisingly enough.
Well, I think part of that was caveated by the starting size or the starting level of sales, right? So on that basis, the only companies that would have really violated that or broken new ground would have been Amazon and Apple, right? So Apple was number 6. Amazon was number 3. They both started from a multi-billion-dollar level of sales. Amazon was over 10 billion and Apple was almost 20 billion, and they both grew sales 29 and 21% compounded respectively over that 15-year period. Pretty much everybody else on the list started as a relatively small company, right? I mean, the next biggest company after that would have been Sherwin-Williams or Nike, I guess. Nike and Sherwin-Williams were really the only other two.
Right, and increasingly you see companies stay private longer. So like the runway to get those opportunities is even less today. I mean, you think back to Facebook's IPO, right? Like even
they're
as
nowhere
far
to be
as
seen.
Yeah, it's impossible.
I guess they came
at
public
scale.
too late for this too, but that's true. Yeah.
Yeah, well, too late, but they were so big by the time they came public. Look at some of the IPOs today, even like Coinbase, UiPath, both within the last week. I mean, these are like really big businesses. To grow 20% CAGR from here requires something like truly extraordinary.
Yep. Yeah. So the takeaways I had from this were that starting size and starting price are both going to be important. And then if you were to map these companies, you know, with kind of the upside down chart where you looked at how far below their all-time high they were, you would have seen some just vicious drawdowns. I mean, it would be fascinating to know how many insiders how many insiders that own the company today didn't get washed out along the 15 years, right? I mean, I bet very, very few people were able to hold on this whole time. And if you could, I mean, this is just career-making generational kind of wealth that you can generate by holding on to these companies. And then the third thing that jumped out was that, yes, there were some companies where I highlighted about half of them where I should have been able to know better. Some relatively simple businesses like Domino's, number 18, Chipotle, number 19, Trex, number 20, Decker's Outdoors. You know, forget about Netflix and Amazon. I mean, unbelievable businesses that, yes, I should have been able to figure out, but there's some downright boring businesses in here that are not above anybody's level of comprehension. Old Dominion Freight Line, right? Literally a trucking and logistics company, is number 13 on the list at a 25% return over 15 years with only a 9% growth rate.
Were they a levered stub in the beginning or something?
They had to have had some leverage on there. I'd have to go back and look. That's a good question. But the sales multiple went from under 1 to over 6, which helps.
That'll do it, right?
Yeah, that'll do it. So where would you have washed out? I mean, I don't know that I would have stuck around that whole time, right? I would have seen it as too expensive or slowing down or God only knows, right? And it just, all you had to do was buy a good business at a good price and sit tight.
Yeah, well, it's interesting. You know, I struggle with these questions along the way too, because you could start with something. I mean, when I bought Roku, I thought I was paying 3 times 1 year out platform sales, and then it was trading at 30 times total sales in the last year, right? That obviously says it's been a good one, but like it's hard. It's like a very different business proposition and wager. So I don't love the word wager there, but I think it expresses what I'm getting at. It's hard to know like how to think about what the forward return prospects are from different levels. I actually do find price to sales like really interesting and important and underrated as a metric insofar as analyzing growth companies go. What I like to use price to sales for is backing into an implied out year margin expectation. And that could be very helpful in informing your research and to what extent you think that margin structure is possible. And if the implied market structure by price to sales is actually, too low for what you think, that's a good signal that you have an opportunity to get a rising price to sales, multiple expansion along the way. Though it
Great.
obviously requires. Go ahead. Sorry.
No, I was agreeing with you. Yeah, I agree 100%.
Yeah, I mean, but there are other ways to kind of like come at the same problem. You're obviously talking about a company with good growth prospects and operating leverage that we were talking about above, but you could get a very specific number out of it that's saying like, this is the hurdle that I need to triangulate against. Like, is it possible? And that's valuable.
Yeah, I agree. It is very valuable. And I think where that kind of analysis gets abused is when people are using it as a pricing exercise rather than like a starting point for a valuation process. So in a pricing exercise, somebody says, oh, I'm going to slap a 10 times sales multiple on this thing because that's what other companies get. And so that's what this should get, rather than just saying like, no, this is where this is, this is an insight into what could be possible in the future and what they might grow into, et cetera, et cetera. Whereas it can be very valuable. And again, it can also be a guidepost, right? I mean, again, if you're buying something above 10 times sales, it means you have to be even more right than usual, right? It's a high bar. It's a very high bar. So I think it's a good framing tool.
Yeah, I think it's fascinating to think about, would you have held on? And I have to admit, I'd have a really hard time holding on in a lot of those cases. I think for valuation for me would be the biggest reason to not hold on. I think, Elliot, you talk about Roku at 30 times sales. Yeah, I mean, it's a really tough one because you basically can take that money and potentially put it into something that you feel just as strongly about that's at a much lower multiple of sales. So we do always have these trade-offs and opportunity costs. And I think with hindsight, when you look at some of these biggest winners, you say, well, yeah, of course, someone should have held on. But I think, ex ante, it's really difficult to make that case a lot of the time. And some of those winners on the list, I never would have guessed, like a Domino's pizza. I mean, just I remember their product quality would have said, there was like in the early days of YouTube, there were like YouTube videos posted showing like what the folks do behind the scenes to those pizzas. I mean, it's just really hard, I think, to figure this out before the fact. And then, just I think it's also a commentary on the time we've been through in the markets. What you mentioned, Phil, about almost all of these companies having seen multiple expansion, where actually as your market cap grows, you should see multiple contraction. So, when you have an Amazon, I think, Phil, you mentioned going from like a 16 billion market cap to 1.6 trillion, and you still have multiple expansion to where today the price to sales is higher than it was back then. It's, that really has to line up with a huge bull market. And if you don't have that underlying tailwind, a lot of these things are going to look different.
Yeah, I couldn't agree more. And that's what's so amazing is you had this unbelievable tailwind. And again, that's why when you look at the numbers, I mean, 10% on the S&P 500 and almost 16% on the NASDAQ for 15 years is like an unbelievable generational tailwind. And yet the volatility along the way was crazy, right? I mean, maybe not so much for Amazon, but they certainly had some volatility. But you had two generational crises jammed in there. And yet you still had start to finish multiple expansion in a pretty dramatic way. I mean, to your point, you now have a company with a $2 trillion market cap like Apple, where the price to sales multiple more than doubled. It's not like Apple was unknown back then. A lot about the company's changed, and it went from big to gigantic, right? And to your point, the multiple went way up, and we'll have to see. I mean, it was obviously deserved in large part, but what it means about the future is the fascinating part.
All right. Well, fascinating discussion, guys. As always, thank you so much. And thanks everyone for listening as well. See you all next week. Take care.
Thank you for listening to This Week in Intelligent Investing, brought to you exclusively by MOI Global, the research-driven membership organization. Learn more at moiglobal.com.